One. Hi, everyone. I'm delighted to welcome Eric Jackson, who needs absolutely no introduction. He's leading the charge for a new kind of activism campaign at Open Door Technologies, ticker OPEN. I'm Alex King. I'm the founder at Cestrian Capital Research, and for disclosure, I'm a shareholder in Open as a result of Eric's work. Eric, hi. Thanks for coming to spend time with us. Great that you could come to talk to us.
Great to meet you, Alex.
You too. Just a little bit of background on Eric. So he's a long-time hedge fund manager. He's had his successes and he's had his hard yards, just like anyone in the industry. Most recently had a rip-roaring success with Carvana, which was completely written off at the depths of the bear market in 22. And he turned that into an absolutely colossal win as a result of some genuine research as to the fundamental and technical potential of the stock. And so for anyone that followed that incredible success story, watching Eric find another target, which he has with Open, immediately should get everyone's attention. And in my book says, well, let's give this guy the benefit of the doubt because he has achieved terrific things with a similar situation beforehand. So Eric, for anyone that's not familiar, maybe you just do 2 minutes on how you spotted Carvana and how it worked out, just to set the context of what's going on here.
Sure. So I started my hedge fund in 2016 with a billionaire gave me 25 million to start with, and I'd met the billionaire because I was involved in a previous activist campaign against Yahoo, and the billionaire who wasn't a billionaire, I guess, when I first met him, but he subsequently became one. Was familiar with me from that experience. But he said, like, how about I give you this money? You go find some like interesting companies to invest in, but maybe don't do that activism stuff anymore because, like if you go off and you say, I think Marissa Mayer is terrible. And then it turns out like one of my companies has a relationship with Marissa Mayer down the road, like some Wall Street Journal reporter might, figure it out and they say, oh, well, like Eric is saying that she's terrible. That must mean that this billionaire thinks that she's terrible and we don't want that. So can you just find like you have such a good eye for like these like early companies, before they become big companies, like find those and like passively invest in them. And so I said, sure, I'd be happy to take your money and do that. And so that's how it started. And I traded Carvana from the 2017 period to like 2020. I made good money from Carvana because it went from like 10, I think it was like $10 IPO to $400 at the very high in 2020 before the interest rates got jacked up, and then it collapsed. And so, and I probably lost money in the 21 and 22 period because I did terribly during those 2 years. And basically because names like Carvana and others like Roku or Twilio or Upstart, like they got shellacked in those 2 years. But I certainly knew the company and saw that it had bottomed out at $3.50 in December of 22. And so it was, but after the billionaire took his money out at the end of 22 because of my losses, I figured, oh, I got it. I mean, I didn't know whether I was going to continue on with my hedge fund. But I wanted to, even though like I had all these like high-priced lawyers and fund directors and stuff saying I shouldn't. So I just sort of continued on, and I knew that I wanted to avoid those mistakes of 21 and 22. And so I thought like, well, maybe if I built an AI team at my company, that they would help me better see those kinds of storms coming and protect myself against that. And then obviously, like, AI seemed like it was going to be the future of hedge funds one way or the other. And so I might as well be at the sort of the surfing the wave rather than, just some like guy 5 years later, like trying to catch up with everybody else. And so we started building a team, and it was initially just one guy in Canada, one engineer who was working with me. And the first iteration of the first model he built in May of 23 flagged Carvana as like what should be my second largest holding in the fund. And that was when Carvana was $11, up from $3 or 3.50. And at first I wasn't like quite sure that there wasn't something wrong in the model. I had him check it. He came back a week later, said it was, and we bought it. I bought it, and then like went on TV a couple weeks later and sort of banged the drum. And that, you're right that it definitely helped, enjoying that uprising. gives me more credibility today when I find some new 100x opportunity, because I'm the only guy who's basically saying that Carvana was a screaming buy when it was that low. Ever like I, but what's interesting is like just nobody paid attention to Carvana. I think until it got above $300 a share again, and now it's a couple of weeks ago it got to 413, so higher than it was.
This is a leading indicator of success, though. We publish research ideas all the time, and you always know when you get hit with complete crickets and tumbleweed in response. You think, okay, that's a really good idea. No one's really onto that. It's wildly unpopular. Makes you check your judgment, makes you go back and do your work again. But it's actually when you think, okay, I might be onto something here. It clearly worked for you. I'm
Right.
interested in how you took all those skills and that experience, and then why open door? Why does that process and that knowledge and that intuition? Why did that lead you to open door particularly?
Well, I was on a podcast in June 22 with it's called The Compounded Friends with Josh Brown and Michael Batnick. It's a popular financial podcast. And June 22 was sort of like when crypto was melting down, tech stocks were melting down. It got worse than June 22. I was thinking in June 22 it was the bottom, but it had another like 6 months to go before things finally bottomed. But of course, that was the topic of the moment in that podcast, and so they were asking me like, okay, well, what are two stocks which the market's getting wrong and that will turn around? And so I mentioned Carvana and I mentioned Open Door, and I felt like both, I traded in both stocks before. I felt like they were getting overly penalized. They were very similar companies. Carvana is obviously like their whole mission was to make a more efficient process for buying or selling a used car, rather than dealing with the dealership where they take their little cut out of it and being kind of awkward going through that process. What if you could just deal with some trusted brand direct, the way that we deal with Uber or Airbnb direct, rather than going through some like middleman or whatever. And Open Door is trying to do the same thing. They're trying to do that in residential real estate in the U.S. So like, don't deal with the agents, don't deal with the 6% commissions, deal with us direct, sell your house through Open Door. We'll give you a fair price. You'll close quickly. And for a lot of Americans, that's like that price and speed are very important drivers of a real estate transaction. And so um, they both had a lot of debt. I sort of felt like they were going to make it, though. They would get kind of eventually cut back on costs and get to steady state profitability and make the turn. And so after the podcast, it took another 6 months, but eventually Carvana obviously made the turn. But Open Door just did not, and things kind of got worse. It seemed like, and my like little position in Open Door sort of kept melting, and then eventually I sold it probably a year ago and stopped paying attention, frankly, to the company. But earlier this year, I decided, like, after building up my little AI team at my hedge fund, and we tried lots of stuff and lots of different strategies, and sometimes we'd have like up 40% months, and sometimes down 60% months, which is not ideal. We were throwing all this spaghetti at the wall. I sort of in the spring, I said with my four guys at the time, like, okay, we got to just sort of focus on what we've done that has worked. And what seems to have worked is finding these 100 bagger ideas, and kind of getting into them and maximizing them. I don't think I maximized the Carvana opportunity. I did a 10x on Carvana from 15 to 150, but I sold it at most of it at 150. And then I thought to myself, the damn thing's so volatile because it had probably three different 60% drawdowns between 15 and 150. Maybe I'll just be a smart, like, active trader and like sell it at 180, buy it back at 130, sell it at 240 and buy it back at 170 and that kind of thing. But I'm pretty sure that if you added up all my trades from 150 to 400, I probably lost money on trading Carvana, just because when you're never that smart, you don't pay attention, you miss these moves. Then, if you do jump in, you're probably too late and all this kind of stuff. So, I sort of made them in the spring. I said, "Hey, I'm gonna find these 100 bagger ideas. Just gonna buy a huge position at the beginning, hopefully at the bottom, at the $3.50, and then just ride it, and just like not trade it." And so that's what I've been trying to do with Open Door so far. And there are big down days and big pullbacks, and but that's sort of par for the course. Not just for these kinds of stocks, but if you take any of these mammoth tech stocks today, like Oracle, Microsoft, Apple. Apple had three different times where it had in excess of 70% drawdowns as a public company between the 1970s and today. So it's just
Yeah, I mean, it's part of the course with these highly volatile names. So the thing that I find interesting about Open Door is you get this allegation of it's just a meme stock at the moment, and it isn't. I mean, the plan will succeed or it won't, but the business itself has real potential. It's not like AMC, it's not like GME, which were purely option driven structures that drove the upside. This is a real business turnaround that you're talking about, and if we sort of step back a few weeks and the stock was trading at, 40, 50 cents, the CEO now departed was selling stock famously at 52 cents. And the board had agreed to do a reverse split to keep the stock above $1 and keep it listed on the NASDAQ. Since the work that you've done, you've got good fundamental analysis, a thesis on, where you think the company can go to and why. And of course, you've done a tremendous job in publicizing, the opportunity that you believe that the board and its current shareholders have missed. And the stock's now sat at 450 or so, having been a little bit higher as well, which is, incredible. I'm curious as to the board's response or lack of it. And why I say that is because, there's nothing new about activism in shareholding. You know this. As you said, you worked on an activist campaign with Yahoo, and there's been plenty of successful activist campaigns in tech lately. Elliott Advisors were in Pinterest very successfully, Autodesk successfully, and a while back now, Value Act had a tremendously positive impact on Microsoft. And so there's a playbook for boards, right? So when a fund like that takes an activist position, there is a process that boards go through. They'll meet with the activist investor, they'll decide to make the investor go hostile, or if they're smart, they'll make a friend of the investor, work out a plan, and declare joint success. Whatever changes that have to happen in the business, new management team, restructuring. Pinterest did a lot of this, as you know. And this time it's been strange, right? It's just silence. And yet, the noise from a growing army of concerned shareholders is deafening. You have institutional shareholders in the business, you have hedge fund shareholders in the business, some fairly prominent ones. Silence from the board. What do you think is going on? So if you're in the boardroom right now, if you're a fly on the wall, what do you think they think?
Well, I've had some conversations with some of the board members, two of the board members. I won't say who. Like phone conversations, private DMs. So I think I have a sense of what they're thinking, and I obviously have my experience dealing with Yahoo's board for like almost 10 years. And I would say, like, in general, like, I don't think the board's response is really all that different from what most corporate boards' responses would be. I mean, it's really no different from Yahoo's board. Now, they were a bad board too. I mean, but I don't know, something happens to smart people when they're put in these positions on boards where everyone's nervous, everyone's covering their butts, everyone's sort of fearful of some like shareholder lawsuit. And so they clam up and, they don't want to say anything publicly that will come back to haunt them later. So it's best to say nothing and do nothing. And I think the playbook is, to treat someone like me as, and this is what Yahoo did effectively for 10 years, was like, he's a loose cannon, he's a noisy shareholder, he's not representative, and he doesn't take the long-term view. Like that was always the mantra of Yahoo's board. You're not taking the long-term view. We wise ones on Mount Olympus here behind the velvet rope, we have the long-term view for Yahoo. It's only going to take another 20 years to deliver that long-term view in terms of shareholder returns, but we are very well aware of everything that's going on. And and you basically just hope that you out resource in my case, I was just like some guy living in Naples. I was a management consultant when I first started that thing. And like I bought a ticket. I remember going on JetBlue from Fort Lauderdale to Oakland, because that was the cheapest ticket you could buy, staying at a La Quinta motel in like Fremont, where like the only other people staying there were like the local tradespeople, like working on different real estate jobs or something like that. And then driving down to Santa Clara in the morning to go to this like convention center shareholders meeting where I like confronted Terry Semel, who was the CEO, like, at the mic, like Gordon Gekko style. And, and again, like it didn't do anything. Like they just sort of like ran the clock out. So I just think that, I don't know. That's a reaction. I'm sure they're deer in the headlights about like just how much this has morphed into like this like GameStop 2.0 retail, reaction. I mean, they up till now, like the mainstream media like CNBC hasn't really covered it, or when they've covered it, they've tried to sort of push us into the box of just like speculative excesses, dumb retail traders doing meme stock 2.0. It's like nothing to see here kind of thing. Like, but I think there's going to be like more and more mainstream like media coverage, which is going to put pressure on them. The thing about this whole campaign that like I mean I've tried to do and I think it's been effective is sort of tie myself at the hip to the co-founders of Open Door, who many of which were sort of ushered out of the company in 21 and 22, including Keith Rabois, who's wrote the original business plan, who's like a very famous VC for Coastal Ventures. And Keith has been particularly outspoken about the problems at Open Door and sort of portraying the woman who quit a week or two ago as a sort of a John Scully type who should never have been appointed in the first place. And so it was always my hope that and part of my blue sky, $82 plus target involved like Keith coming back to the company, not as a CEO, but like as a board member and kind of helping to pick the new CEO and stuff. So very early on, like I've been very supportive of Keith publicly, and I've been fortunate that like he's sort of latched on to me and sort of been very supportive of what I've been doing. And so that now that becomes a very tricky thing for the board to know how to, because they can't just say Eric's a loose cannon. They can't say he's a noisy, ill-informed shareholder. And the other thing that they can't do is like I don't think the Wall Street activist investors are very impressive at all. Even Elliott probably seems to be the one that everybody points to as effective. I don't think any of them, I've never listened to any of them articulate a strategy where I'm like, wow, that is a dynamite tech first kind of a strategy. They're all Wall Street financially oriented people. MBAs driving the bus, and they're usually just sort of lobbying for, a quick sale of the company, pay a dividend out with the excess cash, or sell off a business. Like those are the go-tos. So that if they bought into Open Door, one of these guys bought into Open Door at 80 cents the way I did, I'm sure they'd be lobbying for Rocket Mortgage to come and buy this thing for 250. And they're not in for an $82 score, and which might take 3 years or 5 years or something like that. So and that's what I'm advocating for. So again, like
That's what I find interesting about your approach, which, and I think it's terrific. It's very, very difficult, you say, for the board to say, this guy's a loose cannon. This guy just wants to come in, fire some people, sell some stuff, make some noise and run off with a bag of cash, right? It's very hard to say that because you've been very clear that says, well, there's a strategic opportunity for the business. Timing looks pretty good. It's likely that rates come down. It's likely that that frees up some aspects of the real estate market. It's possible that there are some structural changes to mortgages in the US, which might also free up some aspects of the real estate market. So it looks like the timing might work. And again, it's not like the company had a great plan that was working. If you're at a point where you might be delisted and you have to go through a reverse split, most of which are, a temporary band-aid at best, in my experience, you're not in a good place. And so I think you're
there's
doing.
no moral high ground for them, and as long as I'm with Keith and I'm saying like basically the next move should be you bring Keith back to the board, and I think I should get a board seat too, by the way, and let Keith pick the next CEO. Very hard for them to say, what the heck does Keith Rabois know? We're the smart ones. We're the wise ones behind the velvet rope and stuff like that. And then, by the way, that was the attitude. Like one of the private DMs that I got from one of the directors is that, I was considering, inviting you onto our board. Like it's you should be thankful. I'm throwing you these crumbs. I'm the the king of the world here, and we were going to let you into our secret little club here. And he said, but now you're a loose cannon. You know, your tweets are
Now you stood outside
reckless.
Drake's house, so you can't come on the board.
Right. Anyway,
Exactly.
like, but now, like they can't say that about Keith, right? They can't say he's crazy. He doesn't know. Like they come across as these like this managerial class. So it becomes a very much there's there's so many layers, right? It becomes like this whole like retail versus tech elites, out of touch tech elites,
But
peasants.
you pierce that with Keith's involvement. So I'm
Mhm.
really interested. Maybe we can finish on this point, which is spin this around. Let's say that you're a board member at this company. You are faced with the sort of campaign that you're running. What would you do? You're on the other side of the table now. What do you do? What do you think is the right thing to do? Given as a board member, you have fiduciary responsibility to the business and shareholders. What would you do in this situation?
I'd say Eric, come on the board and like let's turn all this heat that we are facing from retailers and turn it into a plus. Like let's become the new, even more of a darling than Palantir has been amongst retail. Let's be the number one retail stock in the world. And we do that by saying, hey, you're on the board, you're the voice, you're the authentic voice that all of retail can be assured is like breathing fire at every board meeting, making sure we're counting every penny, we're not wasting money the way we have been, and doing what's right to transform this company. And let's bring in Keith. Let's probably bring in a guy like Eric Wu, who was a prior CEO and co-founder. Let's let Keith and Eric select the next CEO of Open Door, and that person, will assuredly like have this sort of 82, $200, $500 vision, and let's get behind that. And some of the directors will stay. I'm sure some will leave, like that, like always happens. And I think that those are the kind of big things that they could do in the next month that would like be, if they did all those things, would not surprise me if this was like a $60 share price stock, 6 weeks from now.
Well,
Like
I think,
because
of course, none of us know the future and none of this is investment advice, but, were the board to embrace that sort of approach, I would be surprised if the stock went down, put it that way. And I believe it would be received positively. And the other thing is, again, about timeliness is that there is, the internet breaks down so many guilds and, marketing campaigns, shareholder activism, these things are somewhat new for the internet. But if you look at the Bud Light experience, the Cracker Barrel experience, there's going to be more of these things, and boards I think are going to have to learn to deal with these things more effectively. So, Keith, I want to thank you for the tremendous work you're doing, and of course to come and spend time with us. You have 101 things to do, so I'm really appreciative of your time here, and wish you all the very best with the work. And that's speaking as a shareholder and as an observer. So again, thank you, Keith, and wish you the best of luck.
thanks, Alex.